Right. Okay. Well, I think we'll start off. Still more joining, but it's hopefully they only missed the introduction. We've got a lot to do. I'll apologise in advance. This might go close to the wire and possibly might even overrun, but hopefully not too much. There's a lot to speak about. Right. So firstly, welcome. My name is Chris Holmes. I'm one of the tax alliance consultants. I'm only briefly talking today, but I'm chairing the session. If you've got any questions and answers, if you've got any questions, there's a Q&A tab in the at the bottom within Zoom. If you open that up and put in your question, that would be great. I would suggest you do it as you go along when you think about them. At the end of every section, we have a Q&A. A quick Q&A when we will try and respond to the questions. I'll read them out and the speakers will answer. Otherwise, the only one thing to just say, a hold this date. If you haven't spotted already, Thursday the 22nd of June is the date of our annual conference. So if you want to put it in your diary, it's our all-day conference in Baker Street. So that's Thursday the 22nd of June. Right, next slide, please. Right, essentially today, news items, we're going to quickly run through some of the budget updates very quickly. It's a very, very high level overview of some of the important points. And then the rest of it is basically a property update. We're going to start off with a direct tax session and then follow up with some of the additional taxes, ATED, SDLT and VAT. Next slide, please. Right, well, we have the dream team of tax line consultants here. Hopefully all of these names you know. Jeff, highly experienced tax line consultant. Amongst other things, he's one of the stamp specialists, so he'll be doing the SDLT. He's also going to do most of the hot topics. Marvin is a member of the VAT team that supports TSP with and he has a particular bent towards property matters. He also happens to be a stamp specialist. He's the only one of the firm who's stamp and VAT, so he's quite useful with those are the things you need. Malcolm, what can I say, our glorious leader, heads up TSP. He's formerly of real estate. He's formerly has a real estate background, so he also has a particular property bias. And he's also the stamp tax champion for the firm, so he's also the stamp tax specialist. Sadiq, a junior member of the TSP team, he's getting fairly experienced, if I'm honest. He and I are the firm's ATED and pensions champions together, so we've been pretty busy the last couple of weeks. And Sadiq's going to talk. He's going to cover the ATED section in today as well. Right, next slide, please. And over to Jeff.
Good morning, everybody. Jeff Webber here. As Chris mentioned, I'm one of the tax line consultants. I'm going to cover the direct tax aspects of news items. I should mention that our comments are based on the documents produced budget day last week. The spring finance bill was published earlier today, but we've not really had a chance to look through it in detail. It was only published an hour or so ago, but we're not expecting anything different from what was announced at the time of the budget. So next slide, please. Looking at the direct taxes, as mentioned in the budget and accompanying documents, capital allowances, good news there. What was described as full expensing means that there are going to be new temporary first-year allowances, but it should be borne in mind that these are for companies only, or rather entities which pay corporation tax. They are in the finance bill, and the FYAs are going to apply to expenditure only on new and unused plant machinery incurred on or after 1 April this year, 2023, and before 1 April 2026. So it's a 3-year window to encourage that expenditure. For main rate expenditure, which otherwise would have qualified for a writing down allowance, the FYA will be 100%, which is the meaning of fully expensed. And for special rate expenditure, it will be 50%. The existing exclusions from first year allowances will apply, for example, cars and plant machinery for leasing. And there will also be anti-avoidance to deal with what's described as contrived or abnormal arrangements to get expenditure within the window if it lacks a genuine commercial purpose. The new FYAs replace the existing super deduction special rate allowance. These expire at the end of this month. Additionally, the annual investment allowance, AIA limit of £1 million, is going to be made permanent. That'll be in the finance bill. And the 100% FYA for expenditure on electric vehicle charging points, which was due to end this year, is going to be extended up to 1 April 2025. Moving on now to investment zones, the government approach is going to be refocused. New investment zones have been announced. 8 areas are mentioned around the country. None of them are in the London area or Southeast England. The legislation will essentially be based on the free ports provision, which means that there will be reliefs for SDLT, reliefs from business rates, additional capital allowances, enhanced rate of structures and buildings allowance, and a certain amount of relief for employer NIC. Moving on now to R&D reliefs. The government had previously published draft legislation, which will apply to accounting periods beginning on or after 1 April 2023. There are a number of changes. This is quite a comprehensive review. 2 new categories of expenditure will be introduced. There's the cost of data licenses and cloud computing services. Additionally, pure mathematics, which were excluded from R&D relief before, now count as allowable expenditure. There are changes to subcontracted work. The proposed restrictions on certain overseas expenditure on contracted work now will not apply as originally thought from 1 April 2023, but will be postponed for a year and will now take effect from 1 April 2024. Additionally, the mechanics of the system are being tightened up, and the requirement to provide additional information will need to be made using a compulsory additional information form. And additionally, there will be improvements to the repayable tax credit for loss-making R&D intensive SME enterprises. The repayable tax credit will go up to 14.5% rather than 10%, which is good news. What is happening though is there is a tightening up of the requirements to try and sift out rogue R&D boutiques. There's now a requirement to notify within 6 months of the first R&D claim, so that the whole system is under review. Some improvements, some admin changes. Next slide, please. As far as cultural and creative reliefs, the news is all good. The temporary increases to the rates of tax credits for theatre, orchestra, museums and galleries, exhibitions, tax relief will extend the temporary increase. Temporary increases, they were originally intended to be withdrawn from April 24, with intermediate rate applying from 1 April 23. The enhanced rates will now continue in full for another until 31 March 2025, with intermediate rate applying for a following year. So this makes these theatre, museums and gallery reliefs extremely attractive. So if you have clients involved in these activities, this is a very useful addition to the relief. And also museums and galleries exhibitions tax relief is going to be extended for 2 years. When it comes to the film, TV and video games reliefs, these are going to be replaced by expenditure credits. So the whole system is currently under review and is going to be changed. There is more detail on this on the BDO website, which also covers all the other budget changes. So if you'd like to see greater detail, do go to the BDO UK website, or you can just Google it with BDO UK Spring Budget 2023, which will take you there. The final topic I'm going to mention is all the changes to pensions, but these are now being covered in greater detail in the next part of our webinar. So that's the end of my introduction, and I'll hand you over to my pensions colleagues. Next slide, please.
Thanks, Jeff. This is Chris. Right, yeah, as the pensions champion for the firm, I actually wrote all of the press releases on budget day and such like, and I'm doing all the internal training. So I've stolen a couple of slides from some of our internal training because that's easier to see it visually, and I can deal with it much quicker. So right, so the first thing to say on the annual allowance changes is basically everybody can contribute more, assuming they've got the cash to do so. That is. Tapering still applies, but it's at an increased level, so you earn more before you get tapered, and it gets tapered down to a smaller amount. So next slide, please. This is where the big headline news is the restrictions of the LTA. But I don't think when you read the press, you don't actually realise you don't actually get the full picture. So right, as it is at the moment, the LTA, which is 1.07 million or a higher amount if you've got it protected, you can get up 25% up to that figure, tax-free lump sum, and when you set the rest of the drawdown. Anything over and above that at the moment, you can draw out, you can leave in there whatever you wish. So you could draw the whole lot out and you take a 55% LTA charge, or you can leave it in there and hit a 25% surcharge. If you don't charge it, but the issue is that there are certain crystallizing events which aren't triggered when you access your pension, such as when you hit your 75th birthday and if you die before your 70th birthday. Those are where the real saving is. Right, so what's happening now is that as and when you access that lump sum amount, the excess amount, whether as a lump sum or as a drawdown, it will be taxed at your income, at your marginal rate of income tax. So the numbers we're talking about, we're going to expect that to be a 45% rate if it's a lump sum. So we're basically swapping a 55% tax rate to 45% tax rate. Yes, it's a bit of a saving, but it's not a huge one. The big saving, so if you choose to leave it in there, you don't suffer the 25%, but you still got PAYE. The real saving is, though, if you decide not to just leave it in there, not access your fund at this point, you don't then get these triggered 25% hits. So you could theoretically, it could be inherited. Your temporary pension could be inherited by your children in entirety. So that's the main thing. Bear in mind that the 25%, the LTA, the protected LTA still applies for 25% tax-free lump sum. So if you've got a protected high amount, you can get more of a tax-free lump sum out. And Labour have said they will reverse all of these changes as and when they come into power. So if they get in the next election in 18 months' time, they say they're going to reverse it. So we need to be careful with any planning we do. We will have an article on our website tomorrow. We will probably circulate it next week as an e-zine, assuming you receive those. So keep an eye out for that one, and it will be a much more detailed explanation of what I've just quickly run through. So, right, next slide, please. And over to Marvin, I think. Oh, no, back to Jeff.
Just very briefly, as we mentioned on these bullet points, downloadable paper returns are now available from HMRC to report UK property gains if the return can't be completed online. A lot of people had complained about the fact that paper return had to be ordered from HMRC, and this caused delays. So this is just HMRC making things more convenient for people. And the final bullet point on this slide is that a new box is to be added to the tax return CGT pages for reporting crypto transactions. There are just more of them around, and it wasn't that easy to report them separately before. So again, this is simply a matter of convenience. Next slide, please. I think this is Marvin.
Yeah, Jeff. So nothing particularly exciting from an indirect taxes perspective in the budget has been the case over recent years. There have been some changes to that were relevant to the medical practitioners. So from the 1st of May 2023, medical services carried out by staff directly supervised by registered pharmacists will fall within the VAT exemption. So this is in line with the rest of the medical exemption, where the exemption applies to services provided by individuals who are acting under the direct supervision of a registered nurse or doctor, for example. So it's an extension of the exemption in that case. Also from autumn of this year, prescriptions for medicines supplied through patient group directions will qualify for zero rating. So this relates to certain categories of medical practitioners who dispense drugs, such as dental technicians and physiotherapists, where the zero rating didn't previously apply, and the zero rating for prescription for the issue of prescriptions will be expanded to these types of practitioners. Okay, next slide, please. The DIY house builder schemes, this is where somebody builds a house and seeks to reclaim the VAT they incur from HMRC by making a claim. The scheme is to be digitised and the claim deadlines to be extended from 3 to 6 months. This is welcomed because it removes the requirement to produce large amounts of paperwork, as is required at the moment, to be able to make a claim. Some changes to plastic packaging tax in relation to the a rate increase that will apply from the 1st of April this year. Next slide, please. Also, from customers' perspective, there'll be a consultation on several proposals with a view to simplifying processes. One key point is that there'll be an introduction of a new process to seek advanced valuation rulings. This is with a view to providing certainty and avoiding any kind of challenges from HMRC after the event. And also some changes to air passenger duties. Okay, next slide, please. 3 other kind of topical points. So firstly, in relation to value shifting, so an area that can give rise to challenge from HMRC is where a taxpayer makes multiple supplies for one price, where the supplies on their own will be taxed at different VAT rates. So for example, a meal deal that comprises a zero rated sandwich and a standard rated drink, or a mixed use development of property where the services from a builder relate partly to the construction of dwellings, will qualify for zero rating, and partly to commercial elements that will be standard rated. The HMRC's concern is that it could be the case that an inappropriate amount of the overall consideration may be apportioned to the zero rated element as opposed to the standard rated element, hence giving rise to a VAT saving. Following a consultation undertaken by HMRC in early 2021 on approaches to deal with what they referred to as value shifting, and in particular whether to introduce specific rules for how consideration should be apportioned, HMRC has now issued a Revenue and Customs Brief, which is Revenue and Customs Brief 2 of 23, and also they've issued updated guidance on how to approach apportionments. The main headline is that HMRC have decided not to make any changes to the law, but have instead issued some practical guidelines. So the document notes that HMRC anticipate businesses will use the guidelines when applying apportionment methods. They also add that businesses who apply the recommendations and can evidence this will lower their risk of arriving at an inappropriate apportionment and have therefore HMRC challenging the method used. So reading between the lines, anyone who doesn't apply the guidelines will almost certainly face HMRC challenge if they identify it. The guidelines highlight 2 main methods to be used, one based on the selling price of the relevant items and the other on the cost of the item. HMRC do say that they would accept other apportionment methods in certain circumstances, but there would need to be justification for this. Overall, there doesn't seem to be a significant change in approach, and there's no new legislation, but the guidelines issued by HMRC are useful. And if you do have any clients that do apportion consideration between various suppliers, it would be advisable to revisit this to ensure it reflects these new guidelines. The second point is the Windsor Framework, which relates to trade and movements of goods between Northern Ireland and Great Britain. And you've probably seen that the MPs voted in favour of the framework yesterday. At the moment, under the Northern Ireland Protocol, Northern Ireland remains part of the EU for VAT and customs purposes. It's also part of the UK for VAT purposes. This results in some additional compliance obligations from both a VAT and customs duty perspective when goods are moved between Great Britain and Northern Ireland. In some cases, the requirement to submit customs declarations. There's a large burden on businesses moving goods between Great Britain and Northern Ireland. What we know so far is that the Prime Minister announced last month that the UK government has reached an agreement in principle with the EU aimed at addressing the problems arising with the Northern Ireland Protocol. The agreement, which has been referred to as the Windsor Framework, will replace the protocol and deal with the issues that the protocol has created, providing a new legal and UK framework. The objective being to enable free-flowing trade in goods between Great Britain and Northern Ireland through a new so-called green lane for goods travelling to Northern Ireland that will remain in Northern Ireland. And it's suggested for those goods, there'll be no checks and minimal paperwork. But there will also be a red lane for goods that are at risk of moving into the EU, where there will be checks and paperwork. It's also promised that the UK government will have full flexibility on VAT rates in Northern Ireland. And in the future, it would allow for new categories of exemption and reduced rates to be applied in Northern Ireland that wouldn't at the moment be accepted by the EU. So it all sounds good, but we don't yet have any detail. And of course, it will be subject to political scrutiny. It could be a very long time yet until any changes are put in place. Final point I was going to mention is around interest, a particular point around HMRC discretion to apply interest. So for that period beginning on or after the 1st of January this year, we now have a new penalty and interest regime in respect of late payments of VAT. With regards to interest, the changes are intended to provide consistency. So the same interest regime now applies to late VAT return payments, amounts due following the issue of an assessment, following disclosures, where VAT is owed to HMRC, etc. And the interest will be charged at the Bank of England base rate plus 2.5%. One point that wasn't clear from the new guidance and legislation is whether HMRC would charge interest only if this results in commercial restitution. So up until under the old regime, it's stated in VAT Notice 743, HMRC will normally only charge interest if this is for commercial restitution purposes. So if, for example, a taxpayer has underdeclared an amount of VAT that would have been immediately reclaimable as input tax by recipient of a supply, then they wouldn't in that case charge interest. So it's quite useful in cases where the taxpayer has failed to charge VAT on supply, but we're able to demonstrate to HMRC that the VAT, if it was charged, would have been recoverable immediately by the recipient. And we successfully argued in those types of cases, interest wouldn't be due. The new legislation and guidance was silent on this point. So we've raised the question with HMRC whether it will still be applicable under the new regime. They've now confirmed to us that the principle will no longer apply. The reason being that the revised legislation gives them no discretion to whether interest is chargeable or not. The HMRC's position now is that interest would still be due, even if the VAT that should have been charged would have been recoverable at the same time. So that's a big change in policy. Okay, that's VAT. Next slide, please.
Next slide, please. Right, thanks so much. Right, okay, we've used up 25 minutes already. There was a lot of budget stuff there, and I realise we've gone through a lot. There's no Q&As in here. We will pick up certain key budget things once you've had a chance to look at the finance bill at the next webinar, if we think it's appropriate. But yeah, if there's no questions, I will just move straight on. So next slide, please, and over to Malcolm.
Morning, everyone. It's Malcolm Pengelly. just going to run you through one particular aspect for this property tax update, and that's the residential buy-to-let market and what on earth is going on at the moment. Very topical, given we're quite likely to have an interest rate rise later today in base rate. Next slide, please. So we're living in interesting times, as they say. Ever since the September last year, interest rates have been on a move upwards. An extra 3% in your interest rate on your mortgage could mean £250 a month more for a £100,000 mortgage. Plus, well, could go up again by another 0.25% today. So life is getting tough for buy-to-let landlords. It's getting more difficult to arrange a competitive fix. Loan to value is dropping as banks become more risk averse. There's less tax relief for interest costs. We've got some examples of that, particularly for individual residential property owners. And that really, combined with the increase in interest rates, is turning what might have been a profitable venture into either less profitable or even loss-making. We'll go through the figures in a minute. And if the financials weren't bad enough, the rental reforms bill is on its way, which is going to ban no-fault evictions, make life a little bit more difficult for landlords. And from 2025, EPC ratings, that's the energy efficiency of your properties, will need to be C rated. And the sort of the jury's out as to how much that might cost to get some of our housing stock up to scratch. But 10k per property doesn't sound unreasonable. So there's a lot of expense coming down the road for buy-to-let landlords. Residential house prices probably going to fall, certainly starting to fall in my area. Are we going to see negative equity again for borrowers? Possibly. And agents report that the 7% yield is now required to break even. But in the southeast, yields have historically been around 5%. So it doesn't take a calculator to work out you're in a loss-making position. So lots and lots of buy-to-let homes have been sold or are coming on the market, and it's an opportunity or a threat, depending on how you look at it. Next slide, please. So if you're a cash buyer, well, you don't need to borrow. There's some good opportunities out there. Rentals are increasing, apparently 11% in Greater London, 8% nationwide. Quite how long that's going to go on for before tenants start to feel the pinch and you get an increased risk of default is anybody's guess. Of course, if you're not borrowing, you don't need to worry about the tax relief. And there will be people out there who are in dire straits. So all these properties that are coming on the market and can't be sold, well, there's an opportunity there to pick them up at a lower price, which as rents are going up, you're going to get a pretty favourable yield. So if you're cash rich, you've got money out there, now might be a good time to pick up a residential buy-to-let. For those who have to sell, because it just doesn't make sense anymore, if you've been in the market for quite a long time, there's probably still some growth based on your original purchase price. Maybe you need to cut your losses and get out. So do all the numbers still add up? Let's see. Next slide, please. So there's a lot of numbers on this slide, for which apologies, but let's just talk our way through it. We've got a 45% taxpayer with a 5% fixed interest rate. It's got 70,000 of rent, 32,500 of interest with net income of 37,500. Okay, so how does this work then? So the table shows the tax on the income. So if you look at row 3, you can see the tax payable has increased since 2016-17 from 17 grand approximately to now 25,000. And if you look at the line above it, well, obviously with the restriction to interest relief down to basic rate, you're getting less and less relief. So you end up at 23-24 with 12,500 cash in your hand. But that's about £8 less than you would have had in 2016-17. So that's where we are before interest rates sort of go berserk. Next slide, please. If interest rates go up to 8%, your net income now is down to 18,000 from what was previously 37.5. So that's a pretty bad hit. And if we have a look at the table, row 4 now shows at a net tax payable of 21.5 in the final column. So hang on a minute, 21.5 of tax. I'm only getting net income of 18,000. Oh, I've got a problem. I've got a net cash loss of 3,100, which compared to the 5% loan that we looked at earlier, when you had 12,500 profit, is not really where anyone would want to be. And in very simplistic terms, this is why people are deciding enough is enough with residential property lets. You know, that's a what, £15,000 move as just as a result of changing interest rates before you factor in all the other costs. Next slide, please. So that was if you owned the property personally. What if you owned it in a company? Well, the situation's not quite so bad. Let's take an 8% interest on a £1 million loan, so the same as the slide we've just looked at. You still get tax relief in full, and in fact from 23-24, if you look at row 2, final column, you're going to get £4,500 worth of interest, which is obviously a fair bit more. So you end up with 13,500 of net rent, which is still positive, isn't it? That's cash you can take out of the company. A lot of people don't obviously take cash out of the company because they leave it in there and reinvest it. So at least you've got positive cash to reinvest, which is better than if you were doing this personally. You're going to pay 5,312 in 23-24 to get the cash out of the company, leaving you with cash in your hand of just over £8,000, 8,188, compared to personal ownership of minus 3,100. So if you're sitting in a company, the effect of 25% tax relief for corporation tax means that you're still at least getting a positive cash flow. Not much help if you're sitting with a property portfolio that is in your personal name, of course, but it's always good to know the difference, isn't it? Next slide, please. Just really for interest, if you are lucky enough to have a fix, then you might still be on a 5% interest rate. And looking at 2023, 24, and we go down to the net cash line, which is in red, then with a 5% fix, your net cash is 17,058. And what do we learn from that wonderful number? Well, 17,058, if you have to remortgage, could well go to £8,000. There are a lot of people out there going, I'm on a fix, I'm okay, but what do I do when my fix ends? And it's not going to be that easy to get quite such a good rate going forward, I'm sure. Your guess is as good as mine as to where interest rates are going to go. But perhaps one should be thinking about what to do next. And well, next slide has got some ideas on it. So next slide, please. So what do we know? Property prices have fallen. CGT annual exemption is going down from 6,000, from 12,000 to 6,000 and then 3,000. So it's sort of saying, maybe I should get out now before things get worse and the tax breaks get worse. What do I do if I'm going to sell? Well, you could invest in the stock market as an alternative. You could reinvest in qualifying EIS companies. You could move from residential to commercial lets. Commercial lets obviously don't have the interest restriction, so you might be paying more interest, but at least you're getting tax relief for it. Or here's an interesting idea, but building on what we've learned in the budget with pensions, maybe when you've got this pot of cash, having sold your residential property portfolio, maybe you're going to think about putting some of it into your pension, perhaps using your pension as an inheritance tax shelter for the next generation. Clearly, there are rules as to how much you can put into your pension. You have to have enough earnings for a start to put the payment into your pension fund. Of course, the pension fund can invest in lots of things, but it can't invest in residential property. So, what else could you do? Well, a lot of people are going out there, and certainly when interest relief was restricted, they started incorporating their property businesses. So if you haven't already, maybe now is the time to think about it. We'll have a little look at that in just a second. So next slide, please. So what are the pros of incorporating? Well, you've got full interest relief because companies get full interest relief for their interest, and you get the limited liability protection. What are the costs? Well, there are two big costs for a start. You can't just gift your shares, gift your properties into your company. So there's going to be a dry capital gains tax charge on incorporation, subject to a possibility of getting out of that. There's going to be SDLT, because even if you gift it into a company you control, market value is the consideration for SDLT purposes. So residential SDLT rates are not to be sniffed at. So those are two big costs. There's going to be legal and paperwork to get the properties in there. There's going to be additional paperwork to run the company. Interest rates tend not to be quite so favourable for company borrowing, and the bank may well require a personal guarantee anyway. For non-resident, non-UK resident owners, there's the delightful requirement to register with Companies House, and all sorts of nasties if you don't do it. So, yes, it's there can be some good savings, as we saw on the slide, but it needs to be navigated with care. Next slide, please. So, the two big costs, I think, of incorporating are SDLT and CGT. How can you incorporate without incurring those costs? Well, there are two very important things. First of all, you need to be incorporating a business. If you're incorporating a business, and you can claim holdover relief under section 162 of TCGA 1992, which means effectively you're rolling over the capital gain on your properties into the shares in the company. In order to do that, you have to be transferring in a business, okay? Which means there has to be some pretty active involvement in running that business. HMRC really are looking for individuals spending 20 hours a week or more. Has to be a proper, fully functioning, running business, not a passive investment. So chances are, if you've got one property, it's not going to be seen by HMRC as a business. It's more likely to be seen as a passive investment. If you've got 20 properties, of course, then that's much more like a business. So that would get you out of the capital gain if you could claim section 162 holdover relief. The other big cost is SDLT, which can run at horrendous rates of up to about 17%. So how do you get out of that one? Well, the answer to that is, if you're husband and wife just owning the properties as individuals and as an investment, the answer is you don't, because it'll just be a market value transfer into the company. If, on the other hand, you have historically run this business and you satisfies the business requirement for capital gains tax, you run it as a business and you run it as a partnership, and I think one would need to look back at what has the business done? Has it been carried on? Has it got business bank accounts? Does it look and smell like an 1890 partnership? If it does, then there are special rules for SDLT, which are quite likely to result in no SDLT if, for example, husband and wife own the properties personally in a partnership, transfer to a company owned by husband and wife. It should be possible to get the properties in there with no SDLT cost. So that would deal with the two big tax charges. Other points to bear in mind, if you're going to take all the money out, well, our calculations show, yes, it probably is worth it at the moment, but generally speaking, we find that people incorporate if what they're going to do is to build a property portfolio going forward. So they pay their corporation tax, they end up with 75% of what's left and keep reinvesting into a property portfolio. So that's probably the sort of scenario we're looking at. There's a big trap not to fall into when you incorporate, and it's important that any existing borrowings, so bank borrowings, need to be novated across to the new company from the old partnership. It's not very helpful to repay the borrowing in the partnership and then take out new borrowings in the company, because that is going to land you with a capital gains tax liability. So it's a small point, but it's an absolutely critical point. Banks are getting to grips with it, but one does need to have a gentle conversation with the bank just to make sure they do it properly. There is Section 75A anti-avoidance legislation, which will scupper your SDLT partnership relief if you deliberately incorporate a partnership, sit on your hands for a period, incorporate it, and you may well then find that what you've got is HMRC saying, no, you didn't really do that. All you really did was two individuals just stuck it in the company. We'll have SDLT on market value, please. Points to take away, deal with the SDLT and the capital gains, and you're halfway there to getting into more tax efficient structure. Next slide, please. Any cues?
Right. Thanks, right. Right, we have one question. Someone has their hand up. Just gonna say, if you want to ask a question, please can you open the Q&A and type it in, and then I'll read it out. So if that's right. In terms of the 20 hours per week requirement, would this apply to both husband and wife jointly? You want to comment on that? I've got an example if you haven't.
Go on.
I've got an example where it was husband and wife, and the wife actually had Alzheimer's or something, so she wasn't working in the business at all, but it was a partnership. And this is when the days they were given the clearance, the revenue gave clearance to both the husband and the wife that it was a business. So the fact that there were, I think he had other people working for him as well. There was employees as well, and they took it all into account. So I would say they don't both need to be working, and would be my answer.
Yeah, I think that's right, Chris. I mean, it needs to look like a business, and HMRC's rule of thumb is, 20 hours a week of somebody doing the work. Yeah. It's one of these things. If it looks like a duck and it quacks like a duck, it's a duck.
Right. No other questions at the moment. So we got to where are we? We got 15 minutes there. I suspect we might overrun if we've got 15 minutes because there's 3 good sections to come. So I will apologise for that now. Okay, over to Sadiq, I think, first.
Thanks, Chris. Good morning, everyone. If you go on to the next slide, you should hopefully see an ATED slide. So if you go into the next one after this one. Yep, so I'm just going to quickly run through ATED. Just because ATED, in 2023, ATED, for ATED purposes, it's a revaluation year. So I'm just going to give a quick 4-minute refresher. So if you go on the next slide. Okay, so what is ATED? So ATED is in the name. So the A stands for annual. So it's an annual tax on dwellings owned by non-individuals. So we're talking about companies and partnerships with corporate partners or collective investment schemes, which are similar to companies. And it applies to dwellings which are worth at least 500,000. So that's when it bites, okay? So it's an annual tax. It's one of those strange taxes where you actually pay the tax in advance for the year. So if a company has a property, it has to file the ATED return and pay the ATED charge by 30th April every year. If you buy the property midway through the year, the company has 30 days from acquisition to pay and file the ATED return. And if it's a new build, you get slightly more time, you get 90 days. And it's done on a provisional basis. So you pay the charge, as I said, in advance. And depending on the conditions, if you meet a relief, you have to still do a return. That's the main point here. So if you go on to the next slide, this talks about single dwelling interest. So a property can have 3 or 4 dwellings in it. If each dwelling within a property is suitable for living as a standalone structure, then each dwelling you need to do an ATED return for each dwelling. And this explains what a dwelling is. So certain accommodation, they're completely exempt from the ATED charge. And this is usually like public bodies. So the main ones that we see are covered in red. So care homes, hotels, student accommodation. You can read this later after I do this presentation. So if you go on the next slide. Okay, so with ATED charges, there's reliefs available. The most common ones are companies which rent out the dwellings as a property rental business. These are all commercial businesses. So if it's a property developer, that's also an ATED relief. If it's property trading and dealing, that's also an ATED relief. The key with ATED reliefs is you still have to do, the company still has to do an ATED relief return within 30 days. So it still has to claim the ATED return. The only time you don't have to claim an ATED return is when the dwelling is exempt. So if it's a charitable body or if it's some certain public bodies, they're exempt and they don't have to do a return. Otherwise, you have to claim an ATED relief return. So if you go on to the next slide. Okay, and this is the reason why I'm speaking today. This is probably the most important slide. So 2023 is a revaluation year for ATED purposes. What does that mean? That means the ATED charge, which will apply from 1st April 2023, that will be based on the market value of the property at 1st April 2022. And that 1st April 2022 market value, that will form the basis of the ATED charge for properties over the next 5 years. So every 5 years, it's a revaluation date. It started when it first came in. So now properties, so clients, which are companies, if you have clients which are companies, they will need to revalue their properties to get a revaluation market value at 1st April 2022. And that will form the base of the ATED charge for the next 5 years. That's the most important thing. Now, what does this mean in practice? Well, property prices have grown in the last 5 years. So a lot of new properties are going to come within the ATED charge for the first time because they've breached the 500k threshold. The charges you can see they're on the right hand side of the page. So it can get really expensive all the way down to, if it's over 20 million, it gets really expensive. And there's quite penal charges if the company doesn't pay ATED, the ATED charge, penal interest and penalty charges. The key point here is if the property is close to those bands that you see on the right hand side, you wouldn't you should encourage your client to get a robust valuation. So seek a property professional's help to get a 1st April 22 valuation. That's the most important thing that I want to discuss, and that's the end of the ATED refresher. So if you go on the next slide, I think Jeff's going to be speaking about SDLT. Thanks.
Hello, it's me again, Jeff Webber speaking. I'm covering topics in SDLT. Next slide, please. So the agenda is a very brief rundown of the current environment, a very quick run through of tribunal and court cases in the last 12 months, covering multiple dwellings relief, mixed use property and main residence, and just a brief mention to finish about HMRC consultation on MDR and mixed use. So next slide, please. Right, current environment. Total SDLT transactions in the last quarter of 2022 were 4% higher than in the third quarter, which is a little bit unusual because usually the number of house sales goes down a bit in the final quarter. However, the SDLT receipts were lower than in the fourth and in the third quarter due to the increase in nil rate threshold and first time buyers relief, which is the temporary relief. Important point is that HMRC does very much continue to challenge unrealistic claims for multiple dwellings relief, mixed use, or replacement of main residence. I want to make the point that in particular, HMRC is well aware that there are SDLT boutiques out there who are in effect ambulance chasers. They will go through the land registry returns and will often send cold calling letters or emails to people who've bought properties who they think might be eligible for multiple dwellings relief or mixed use treatment, and invite them in return for a percentage of the saving to file amended SDLT returns. HMRC look particularly closely at amended SDLT returns where a relief is claimed that was not claimed in the original return. HMRC is well aware of all this, and a consultative document has been published just about 18 months ago, proposing a tightening of the legislation to restrict multiple dwellings relief and also to change the way mixed use properties are taxed to SDLT. We are awaiting the response to that consultative document. And finally, just mention the Scottish Government is also looking at proposed changes to LBTT. So next slide, please. A very quick run through of recent cases on multiple dwellings relief. We mentioned four cases here. The first one is the Alex and Louise Dower case, which concerned an annex above a garage in a separate building from the main house. So prima facie, that looked quite promising for multiple dwellings relief. However, there were legally binding planning restrictions preventing its sale as a separate dwelling. It had been rented out under Airbnb, but the tribunal decided that didn't necessarily mean that it was suitable for use as a separate dwelling. And on the facts, they lost the case. The next one I'm looking at is the Andrew and Tiffany Doe. Again, looking at previous case law, there was an annex which the tribunal decided did not constitute a separate single dwelling. It was used, I think, by family members who had to share certain facilities, and the tribunal made the point that a building is only suitable for use as a single dwelling if it qualifies for this in all circumstances, so that it would be acceptable to any third-party tenant and not to special tenants, for example, members of the family. Next one we're looking at is the Smith Holmes 9 case. Now, this is more an appeal on procedure. They were out of time. They were approached by an SDLT boutique, but they were too late to file an amended return, and tried to go down the alternative route of claiming repayment of overpaid SDLT due to a mistake in the return. This was rejected by the tribunal, who made the point that this was not appropriate use of the legislation, and that multiple dwellings relief can only be made either within the original land transaction return or an amended return. So that route has been blocked. An interesting case was the Marcus and Marcus case, which was quite helpfully decided on the basis of the apportionment of a purchase price of separate dwellings on the basis of floor space on the facts was a just and reasonable apportionment in the circumstances. Next slide, please. Next slide, please. We're now looking at a few cases concerning mixed use. Sorry, you can probably hear my phone going in the background. I'm looking at another 4 cases here. The first one we're looking at is a couple of cases heard together, the Hyman and the Goodfellow cases. And these were the first mixed-use property cases that got as far as the Court of Appeal. They concerned the what counted as garden or grounds. Should they just be treated as grounds, or if they were quite substantial, was there a possible case that they were not residential and should be treated as commercial property? The counsel for the taxpayer tried to run the argument that there was an analogy with PPR, capital gains tax relief, on the basis that in the CGT case, there was a restriction on the amount of land that counted as ground or garden if it was in excess of ½ a hectare, and you had to show it was required for the reasonable enjoyment of the property. Counsel for the taxpayers here tried to run an analogous argument in relation to SDLT. It was simply rejected by the Court of Appeal, who described it as an ambitious exercise to imply into an Act of Parliament a limitation which was simply not there in the legislation. So that one failed. An interesting case, one of the very few which has succeeded, was the Gary Withers case, where a farmhouse was bought with around 25 acres of land attached, which was partly used for grazing by a neighbouring farmer and partly used by a woodland trust under a rewilding project. On the facts, the tribunal decided that that land did not constitute garden or grounds and should not be treated as residential property on the basis of its actual use. So that case is well worth looking at if you do have any cases of people buying farmhouses with substantial amounts of grazing land attached. The next case I'm looking at is the James and Charlotte Averdyk case, where the additional land had a lane running through it where the neighbouring farmer had an easement so he could use it to access his farm. They tried to run the argument that the lane to the farm did constitute a commercial operation, and therefore this was mixed use. This was rejected by the tribunal on the basis that it didn't constitute a commercial operation. It was like any other public right of way, and that argument was just not going to wash. The final case I'm looking at here is the Daniel Ridgway case, where a grazing license was I'm sorry, not a grazing license, where there was a couple of properties were bought, one of which had previous commercial use, but was not being commercially used at the time, and was suitable for residential use. The buyer, in cahoots with the seller, arranged between contract and completion for a third-party commercial tenant to be introduced. However, the the tribunal looked at the situation in the round and decided that there was no commercial justification for doing this, so that the anti-avoidance in section 75A should apply. The taxpayer was out of time to claim multiple dwellings relief, but very interestingly, the tribunal decided that as section 75A was in point, section 75A enabled the tribunal to look back at the reliefs that could be claimed and imputed multiple dwellings relief, and therefore, even though the mixed use claim was thrown out, to everybody's surprise, the tribunal decided that multiple dwellings relief could be claimed, even though it was technically out of time. Next slide, please. Finally, looking at the additional 3% SDLT and the exemption or relief from this, where there is replacement of main residence. The Benjamin Cohen case indicates that the tribunal will look at this in the same way as they look at whether a claim for PPR relief in relation to CGT is valid. In other words, a residence must actually be used as a residence. It must have that element of permanence. And in this particular case, the property was only owned for a few weeks and he only lived there for a week or two. On the facts, the tribunal decided that this was simply not a residence and therefore the relief could not apply. Next slide, please. Finally, just a heads up on the consultation. This was launched back in November 21. Various methods of applying SDLT to mixed properties were proposed. The two main alternative ones were an apportionment method. So where you have mixed property, the commercial part would be liable to SDLT at commercial rate, and the residential parts would be taxed at residential rates. Alternatively, they looked at a threshold method, in which case it wouldn't be treated as mixed property unless the non-residential element was more than a certain proportion. Next slide, please. With regard to multiple dwellings relief, the consultation outlines 4 options. I won't go through all of them now. You can see this when we publish the slides. Suffice it to say that the outcome of the consultation is awaited. Obviously, the government's had more pressing matters to deal with since November 2021, but we are hopeful that there will be some action here eventually. Next slide, please. That covers the SDLT part. I'll now hand you over to Marvin to cover off VAT.
Okay, well, thanks, Jeff. Could you next slide, please? Okay, so I'm just going to talk about some changes to the option to tax. So there's been some significant changes to how HMRC will process options to tax that are notified after the 1st of February this year. So this is where a business wishes to charge VAT in respect of a supply of non-residential property that would otherwise be VAT exempt. So the purpose usually being to enable the business to reclaim VAT that it incurs on costs relating to that supply. For an option to tax to be valid, it must be notified to HMRC within 30 days, and you usually use a form 1614A to do that. Previously, HMRC would have carried out some checks, and then they would have issued a letter formally acknowledging the option to tax. This option to tax letter was an important document to be able to prove that there was a valid option to tax in place, and would often be requested by lawyers, for example, prior to a property transaction. Given the lack of resources at HMRC's option to tax unit, you may have noticed long delays in HMRC dealing with option to tax notifications and other related queries. Because of these delays, HMRC were looking at ways to improve the process and to free up resources. And following a extremely limited consultation period, HMRC has now confirmed that it will no longer carry out any checks at all and will not issue any letters confirming receipt of an option to tax. So the formal option to tax letters that we're used to seeing will no longer be issued. HMRC has said, though, is that as long as a notification is sent by email to the usual email address for the options tax unit, the sender should receive an automated email response showing the date when the notification was received by HMRC. HMRC also advised that as long as you put the subject, as long as in the subject matter of the email, you put the property address and the effective date of the option to tax, the email response should also include the same details in the subject line. So there were some concerns initially that the relevant details wouldn't be shown on the email that you get back from HMRC. And particularly at first, there were some discrepancies around what information was actually included. But that seems to have been resolved now and it's working as intended. So the email response should include in the subject line the same subject line as that sent to them in the first place. So although not ideal, the automated email should provide evidence that an option tax has been submitted. A notification sent in any other way, so for instance by a letter or as part of a VAT registration application, will not receive any acknowledgement or receipt. So one problem with emails that you probably have seen in practice is it can be easily lost and not filed properly. So for example, when the recipient of the email leaves the business. So we're strongly suggesting to clients they put into place robust processes to keep detailed records of options tax notified to HMRC and the automated email responses received back, because it would probably be necessary at some point to produce this evidence to prove that an option tax has been made. One other change is that HMRC are restricting the circumstances when they'll check their records for options to tax previously notified. This is often necessary prior to a transaction for the seller to prove that it's entitled to charge VAT on the sale of property. It may be the case that an options tax was made a few years ago. No one in the business knows whether that was done or not. So you can ask HMRC whether they have any record of options tax. HMRC is saying that they'll only now respond to such requests if the effective date of the option tax is likely to have been more than 6 years ago, because they say that a business should be keeping records for 6 years anyway, or if the sender of the notification has been appointed as a land and property act receiver or an insolvency practitioner to administer the relevant property. So from a practical perspective, I can see these changes causing lots of difficulties in proving that an option tax has been notified. There could be uncertainty as to whether an options tax is actually valid. So, for example, this might be relevant prior to a land transaction, as I said, to prove that the seller is entitled to charge VAT. May also crop up on a due diligence review. The business being reviewed may need to provide evidence for an option tax made, or it may even crop up during a HMRC VAT inspection, to where HMRC may say they'll prove that you've made an option to tax. It's vitally important to ensure that a business retains as much evidence as possible that it's opted to tax and can produce this on request. Okay, next slide, please.
Right, thank you very much, Marvin. Right, we've had a few questions come in. So firstly, thanks everyone for sticking with us for the moment. Right, I know it's a couple on ATED. If you don't mind, Sadiq, I'll quickly answer these ones to save time. What about ATED and incorporations? Effectively, ATED will apply to the company as soon as it's acquired, but we might expect if it's a rental properties for relief to be available. So it may well be it's more of an administration burden than a cost. Next one, if a property value drops between the 5-year intervals due to COVID, can you go back and claim overpayment relief on tax overpaid when it's used by a connected person? Unfortunately not. The valuation points are the 5-year anniversary, the fifth of, there are fixed valuation points every 5 years. The only other time you take a value is when you've actually acquired a property or there's been some substantial change to property. So, for example, if you convert one building into 2 flats, that might mean you've got a change and you revalue it at that point. So unless there's something substantial like that, which means you've got different dwellings, then unfortunately you can't simply claim back an ATED refund because there's been because the property values dropped below a band. Right. I think this is back on incorporation. So back to Malcolm. Follow up, is an average number of hours worked over the tax year leading to incorporation sufficient to meet the 20 hours per week requirement? You got a thought on that, Malcolm? is Malcolm, you here? Oh well, I'll respond if he's not.
I'm here.
Oh, okay.
I'm here. I'm here. I needed to push the button.
Yep.
Clearly, it's a rule of thumb is the 20 hours per week. So, you know, and it's a case of looking at it in the round. So I don't think sort of going absolutely berserk just before incorporation is necessarily going to prove that you're running a business. Chris, any other thoughts?
Well, I don't think it has to be. Yeah, I think an average, it doesn't have to be 20 weeks every single week, because there's certain things, you know, you might find you're more active when you're changing the tenant. So there might be weeks where you're pretty busy, and other weeks where you haven't got any change of tenancies, a lot less. So, but I think it is sort of on average, it's in the round that they look at. But if you're just looking at, is it just for the year with the revenue? It's one of those things. But as I said, as you said, the 20 hours derives from Elizabeth Moore and Ramsey, doesn't it? Because that was what the court found in her case.
It's a qualitative test, really, isn't it, rather than a quantitative test?
Yeah. So that we simply know that's what the court's already ruled on a case where it's 20 hours. So that's what the revenue will accept. If it's less than that, it still might be a business. It's just not been tested in court. I think that's it. Right. So no more questions come in. So all I've got to say then is next webinar, I think is in April. I think it's the 12th of April. I think we brought it forward because there's a few holidays in the team, so we've had to bring it forward. And just a reminder, our annual conference, Thursday, the 22nd of June. If you want to hold that date, there'll be some invites coming out shortly once we've got the agenda organised. Otherwise, thank you very much. No feedback poll today, but just thank you all for joining us, and hopefully you found it interesting. Thank you very much.